Good day, everyone, especially to Ma'am Candy. Good afternoon, Ma'am. Today I will discuss my report. The title of our report is the balance sheet. What are the financial statements? Financial statements provide a picture of a performs financial position and cash flow of a business. These documents are used by the investment community, lender, creditors, and management to evaluate an entity. There are four main types of financial statement, which are 1. Income statement, 2. Balance sheet, 3. Statement of cash flow, 4. Statement of exchange equity. Balance sheet. Balance sheet is refers to financial statement that reports a company assets, liabilities, and stockholder equity at a specific point in time. In short, the balance sheet is a financial statement that provides a snap of what company owns as well as the amount investment by stockholder. The balance sheet is based on fundamental equation, asset liability equation. Components of balance sheet: assets, liability, equity. Total asset is calculated as the sum of short-term, long-term, and other assets. Total liabilities is calculated as the sum of all short, long-terms, and other liabilities. Total equity is calculated as the sum of net income, retained earning, owner contribution, and share of stock issue. There are samples of balance sheet. Assets: current assets, checking account 5,000, saving account 1,000, petty cash 500, account receivable 20,000, inventory 15,000, prepaid insurance 6,000. Total current asset is 49,500. Liabilities and equity. Liabilities, current liabilities, current payable 12,000, line of credit 20,000, payroll liabilities 7,000, total current liabilities 39,000. Non-current asset: accumulate depreciation 4,500, computer office equipment 7,000, building 65,000, land 60,000. Total non-current asset is 127,500. Non-current liabilities: long-term 48,000. Total liabilities is 87,000. Equity, owner's capital 35,000. Retained earning 55,000. Total equity 90,000. Total liabilities and equity is 700. Sample balance sheet. Assets: current asset, checking account 5,000, saving account 1,000, petty cash 500, account receivable 20,000, inventory 15,000, prepare insurance 6,000. Total current assets is 49,500. Liabilities and equity. Current liabilities: account payable 12,000, line of credit 20,000, payroll liabilities 7,000. Total current liabilities is 39,000. Non-current liabilities: long-term debt 48,000. Total liabilities 87,000. Non-current asset: accumulate depreciation 4,500, computer office equipment 7,000, Building, 65,000. Land, 60,000. Total assets, 177,000. Equity, owner capital, 35,000. Retained earning, 55,000. Total equity, 90,000. Total liabilities and equity, 177,000. Asset. An asset is a resource that owned or controlled by a company and will provide a benefits in current and future periods for the business. In other words, it's something that a company owns or controls and can be used to generate profits today and in the future. Current asset. Cash and cash equivalent are the most liquid assets and can include treasury bills and short-term certificate of deposit as well as hard currency. Account receivable AR refers to money that customer own the company. This may include an allowance for doubtful account as some customers may not pay what they own. Inventory refers to any good available for sale, value at the lower of the cost or market price. Prepared expenses represent the value that has already been paid for, such as insurance, advertising, contract, or rent. Long-term asset. Long-term asset investment are securities that will not or cannot be liquidated in the next year. Fixed assets include land, machinery, equipment, building, and other durable, generally capital-intensive assets. Intangible assets include non-physical but still viable assets such as intellectual property and goodwill. Liability. A liability is a financial obligation or a company that results in the company's future sacrifice of economic benefits to other entities or business. A liability can be an alternate to equity as the source of a company financing. Moreover, some liabilities such as account payable or income taxes payable are essential part of day-to-day business operation. Current liabilities. Account payable, these are the unpaid bills to the company vendor. Interest payable, interest expenses that have already occurred but have not been paid. Accrued expenses, expenses that have been incurred but not supporting document. Invoice has been received or issued. Short-term loans, loans with a maturity of 1 year or less. Long-term liabilities. Bonds payable, the amount of understanding bonds with a majority of over 1 year issued by the company. Note payable, the amount of promissory notes with a majority of over 1 year issued by a company. Mortgage payable, long-term debt, is a company take not a mortgage or a long-term debt. It record the face value of the borrowed principal amount as the non-current liability on the balance sheet. Equity. Equity is the net amount of the fund's investment in a business by its owner, plus any retained earning. It is also calculated as the difference between the total of the recorded assets and liabilities on an entity Balance sheet. Equity can indicate an ownership interest in a business such as stockholders' equity or owner equity. Type of balance sheet. Common size balance sheet present not only the standard information contained in a balance sheet but also a column that notes the same information as the percentage of the total assets for asset line item or a percentage of total liabilities and stockholder equity for liability or stockholder equity lines term items. It is useful for contracting trends line to examine the relative changes in size of different account. Common size balance sheet. Asset balance sheet, common size. Cash 16,000, common size 22%. Inventory 17,000, common size 24%. Total current asset 25,000. Common size balance sheet. Assets balance sheet or common size balance sheet. Cash 16,000, common size balance sheet is 22%. Accounts receivable 17,000. Common size balance sheet is 24%. Inventory 25,000. Common size balance sheet 35%. Total current asset 58,000. Common size balance sheet is 81%. Property, plant, and equipment 14,000. Common size balance sheet is $19. Total asset 72,000. Common size balance sheet is 100%. Liabilities and shareholder equity. Current liabilities is 15,000. Common size balance sheet is 21%. Long-term debt 36,000. Common size balance sheet is 50%. Total liabilities is 51,000. Common size balance sheet is 71%. Shareholder equity 21,000. Common size balance sheet is 29%. Total liabilities and equity 72,000. Common size balance sheet is 100%. A comparative balance sheet is a statement that shows the financial position of an organization over different periods for which comparison is made or recorded. The financial position is compared with two or more periods to depict the trends, direct of change, analyze, and take suitable action. Cross Inc. Comparative Balance Sheets, December 31, 2017. Assets, 39,000 in year 2017 and 2016, 22,100. Ang cash, 2,000. Account receivable net 2017 is 38,200 and 2016 is 46,900. Inventory in 2017 80,000 and 2016 is 88,000. Prepared expenses. 2017 is 4,900 and 2016 is 4,000. Total current asset is 2017 is 212,100 and 2016 is 161,000. Furniture 98,800. 2016 is 113,300. Accumulate depreciation furniture. In 2017, 15,300. And 2016 is 8,600. Total asset in 2017, 295,600. In 2016, 265,700. Liabilities and equity. Accounts payable in 2017 is 13,900. In 2016, 19,600. Wage payable in 2017, 8,200. In 2016, 4,600. Income taxes payable in 2017, 1,400. In 2016, 2,600. Total current liabilities in 2017, 23,500. In 2016, 26,800. Notes payable long term 28 in 2017, 28,900. In 2016, 69,000. Total liabilities in 17, 52,400. In 2017, 95,800. Equity, common stock per value. In 2017, 215,000 and 2016 is 169,100. Retained earning. In 2017, 28,200. In 2016, 800. Total liabilities and equity. In 2017, 295,600. In 2016, 265,700. Importance of the balance sheet. Regardless of the size of a company or industry in which operates, there are many benefits of a balance sheet. Balance sheets determine risk. This financial statement lists everything a company owns and all of its debt. A company will be able to quickly assess whether it has borrowed too much money, whether the assets its own are not liquid enough, or whether it's not enough cash on hand to meet current demand. Balance sheets are almost used to secure capital. A company usually must provide a balance sheet to a lender in order to secure a business loan. Company must also usually provide a balance sheet to private investors when attempting to secure private equity funding. In both cases, the external party wants to assess the secure private equity funding. financial health of a company, the creditworthiness of the business, and whether the company will be able to repay in short-term debt. Thank you for listening.